When the financials have finally bottomed out, our next guest says it won't be happening for a while. Keenan Hauke with Samex Capital joins us now from Indianapolis. Good morning, Keenan.
Oh, good morning, Alexis. I know in the last year, can you believe that it's been 12 months since we learned about those two hedge funds over at Bear Stearns, and a lot of the problems in the financial sector, the home builders and the over-leveraged credit situation really started coming to light. It's been a year. Amazing.
Yeah,
and we've been talking about it for a year, and people have been looking for the bottom.
Yeah,
it's amazing.
You have such a great point here. I want you to kind of review some of these statistics about how much of a percentage loss you have to see in order for a bubble to correct. Compare what's happening in financials to technology, and tell us what you make of that.
Well, technology bubble from 99 to 2002 is the most recent example of a bubble breaking, and it's kind of fresh in people's minds, and they witnessed it. So let's use that as a fresh example. The tech bubble, NASDAQ went to 5,000 by March of 2000, and by October of 2002, Alexis, it had corrected 76% and then slowly started making its way higher. But we look back in history, going back to the Dow Jones crash of the 1929 to 1932 bottom, which of course was the Great Depression, the gold market, the Nifty 50, Nikkei, other areas that we can talk about, and we noticed that these bubbles, these outrageously high runs, typically fall 75% before they're done. It's an absolutely astronomical amount of money to be lost, and people looking for a bottom in financials at July 15th, which was the last low, people say, hey, this was the bottom, but at that point they'd only been corrected 55% from their high in May of 2007, and we think this is going to be at least average, meaning financials are going to have to fall 75% from their all-time high. It doesn't mean they only have another 20% to fall, however, Alexis. That means they have to get cut in half from here in order to fulfill that obligation.
Right. In other words, in order to fill that percentage term basis from top to bottom. You also suggest that it may not be wise to look at the group that has declined that aggressively as the leadership in the market for the next bull market. Tell me more about that.
Right. Well, so many people want to grab on to the final low in Citigroup or J.P. Morgan or Merrill Lynch or Lehman Brothers. That one was in the news not too long ago with a share offering. But the next bull market, and whenever it comes, 3 months, 18 months, anywhere in between, is not going to be led by the financial stocks. It's going to be led by something that you're least thinking about today. I mean, look at the last bull market from 2003 up until last October. Technology stocks weren't the leader. There were energy companies, to some degree home builders, commodity stocks, foreign emerging markets. Those are the things that led. So financials will not lead. They have a lot more to fall from today. So why bother?
Well, all right, so let me ask about energy, because there's a lot of people talking about whether or not energy is perhaps the next bubble, and perhaps it's too soon to make that determination, but what do you think?
Well, I do think that eventually it's going to become a bubble, but when oil was at $147 a barrel only a few weeks ago, that was not bubble-like. You didn't have people at cocktail parties. Yeah, they were complaining about how much they're paying at the pump, but they're not talking about how to invest in it, how to take advantage of it. It's not the conversation that's dictating everything that we do, like home building and real estate and credit was a few years ago, or technology was in 1999. But my opinion, Alexis, is that we will get there eventually, and we could be looking at prices of $200 a barrel or more before the bubble really gets put into place in oil.
All right, Keenan, great having you on. Thanks so much for joining us today.
Thank you.
All right.